Hi everyone. This week I'm going to talk about what's happening with interest rates. The rates began a rapid drop over the last few months. When you look back 6 months ago, the interest rates were 60 basis points higher than they are today, and now they're down around 2.4% or the mid 2.4% range. Last August through October, the 10-year pushed up to the 3.2% range. And then they started to creep down and they stabilized around 2.6, 2.7% through the first part of this year up until the beginning of March. Then a couple of weeks ago, they started dropping pretty fast. So what changed? The Federal Reserve. The Fed decided that they were going to stop pushing up rates, something they'd been doing every quarter for the last year, and really begin to ease their monetary policy. On March 20th, the Fed announced they would stop raising rates this year, and they'd also stop quantitative tightening, where they were letting some of their debt burn off their books and basically using it as a way to artificially raise rates. This caused the market to shift and rates started dropping. Now, one of the more interesting trends pretty much over this last cycle, for the last 6-8 months or so, is that the 2-year interest rate and the 10-year interest rate have kept a spread of about 10 to 20 basis points. And this has continued to this point. Right now, the spread's around 17 basis points. So that's good, because if the 2-year interest rate rises above the 10-year interest rates, that's called a yield curve inversion, and that is one of the commonly known signs of an upcoming recession. So the good news is there has been no inversion, which means we don't have a sign of a recession coming up. And more good news is that interest rates are down significantly and the capital markets are still liquid. So financing is looking better than it has in the last 6 to 9 months or more. So what's the not so good news? Well, there's none yet, but the 2-year Treasury rate is really low. It's down around what the Fed is paying for its overnight rate, the federal funds overnight rate, which is between 2.25% and 2.5%. So that makes it hard for the 2-year interest rate to go lower, and it raises the risk of an inverted yield curve. But in the past, we've seen the 2-year Treasury rate go below the Fed funds rate. In fact, in 1995 and in 1998, we had surprisingly similar set of events where the yield curves were very flat. The characteristics were very similar to what we're doing now. And the 2-year rate fell below the Fed funds rate a couple times. And that growth cycle ran on for 3 years after the last time that happened. So there's still a lot of legs left in the economy. We have very good unemployment rates. We have job creation. We have retail consumption. All of the indicators are still pointing up, and that leads us to believe that we still got some legs in this growth cycle. So what should investors take away from all this? The interest rate volatility is a bit mysterious and it's bouncing around and very hard to predict right now. But capital market liquidity is good. The lenders are active. Rates are down. If investors took a pass on a deal just a few months ago because the yield spreads were too tight over their cost of capital, they should be taking another look. Rates are at the lowest they've been since December 2017, and this is a real opportunity.